And we want to thank everybody for being on the call this evening with David Rumsey, CPA IAR of Pettis Rumsey, Inc. in Marysville, Washington. If you're not a Pettis Rumsey client, David is also a contributing writer to the Snohomish County Business Journal. I think you can get that online at snohomishcountybusinessjournal.com, and you can see the articles that Dave writes on his website at pettisrumseycpa.com. Tonight's call is, I think, titled Maximizing Deductions, How to Minimize Your Taxes by Maximizing Your 2011 Deductions. And David is going to be talking about all the different ways that you can do that and certain deductions and, I guess, changes in the tax law to look out for as you prepare for submitting your taxes here in 2012 for the 2011 tax year. So with that, we want to welcome David to the call tonight. David, can you hear me?
I can hear you just fine, Jeff.
Super. Well, I think it's the top of the hour, a little bit past. Let's go ahead and get started.
Fantastic. I'd like to welcome everybody to the call tonight and anyone listening. And tonight's title, as Jeff said, is focusing on tax deductions. I'm going to go through a list of various topics that I get. Typically each year, a lot of these things will come up, some more than others. And it's just an idea to get you ready to go as we're starting to enter the tax season for the 2011 income tax returns. So this will hopefully get an idea of things that you can do when you're going through either an organizer or looking at last year's return, getting some receipts or things like that. So I think it's an awesome way to focus on just knowing what's out there and making sure that you're not missing anything. I always tell clients income is the easy part. You sit there and you get a W-2 or you get a 1099. For a lot of people, there's not a lot of things they have to worry about as far as the income situation goes. But deductions, that's where we can save some money on taxes, be it whether it's for your business or anything like that. So I always tell people, at this point, at least we can try to focus on that and then lower your taxable income, and we'll start right from the top. So starting off, there's a lot of people will ask me, there's two types of income tax filers when it comes to their deductions. And we're talking basically to start with personal deductions. So these are deductions for your 1040. There is a standard deduction that the IRS will give you based on your filing status, but they also offer taxpayers an opportunity to itemize, which is a lot of people will call it going the long form. Typically, it's Schedule A is the schedule that comes up, and itemized deductions is frankly a whole hodgepodge of different deductions that people are allowed to take against their income. Now, the standard deduction is the bare basics. So if you're single for 2011 tax returns, you're going to get a $5,800 standard deduction, or the itemized deductions that you come up with. And it's the greater of the two. So the good news is if you can get over the standard deduction, you very well are going to have more deductions. But if not, you're just starting out or you don't have a lot of the types of itemized deductions, you're going to get a deduction no matter what. As I said, it's $5,800 for single, twice as much, $11,600 for married filing jointly, and $8,500 for people that qualify under the head of household filing status. So that is pretty easy. If you're following under the standard, you're going to take your total income less the standard deduction, and then you get to take your exemptions or dependent exemptions, and then that will help you get to your taxable income. But tonight I'm going to focus a little bit more on the itemized, because these are the type of things that we want to see if you can follow Schedule A. Because if you can, you're definitely going to be able to do things that will give you more write-offs and therefore lower your taxable income, which there in turn will help lower your taxes come tax time. The first thing that we look at for itemized deductions, if we go from the top of Schedule A down, is medical expenses. Medical expenses can range from things such as doctor visits, co-pays, medical insurance, Medicare premiums, optical, dental, mileage. You can take miles for your trips to the doctor, x-rays. There's literally hundreds of different type of medical procedures that qualify for the medical deduction. And so we want, even traveling away from home, and this is for you and or your dependents. So it's really important to make sure that you're gathering all your medical deductions. It's very important because at this point you need to be aware that income limits medical deductions. So the higher your income, the less likely you'll be able to deduct medical expenses. The way it works is you take 7.5% of your income. So, for example, if your income is $30,000 for the year, you multiply that by 7.5%. That works out to be, real quick with my calculator, $2,250. Any medical amount over $2,250, you're going to be able to deduct on Schedule A. So that's why it's important to count mileage. It's important to keep track of your co-pays, your prescriptions, any of your out-of-pockets, your insurance that's not premiums not covered by an employer. All of those items we want to add up to see, can you deduct a percentage of your medical expenses? We all know with as expensive as medical is, it doesn't take too long to add up. So if you've had a bad year, low income, things like that, then we know that you may have an opportunity to be able to deduct medical on your return. And the thing about this is you always have you always need to make sure that you're looking at this every year, because this is not something that we can say, oh, we're going to be able to deduct medical, and this year that means I'll be able to deduct it every year. If your income's higher or lower each year, you may some years be able to deduct medical, other years may not be able to. So the problem is you need to keep your records, keep your receipts all the way through the year, because any deduction is helpful. It's going to help you get over the standard deduction, but the key is to note that medical is a year-to-year scenario. So if you get to deduct in 2011, you may not be able to qualify based on your income for the next 5 years, but at least you'll be able to benefit for that 1 year. This also is a planning opportunity. I've seen people prepay medical. If they know a bill, they'll have a bill coming sooner, so they can collect a higher amount in the year along with that. So in other words, if you know you're going to be paying for an x-ray bill in January, if you could prepay it in December and add it to December's, because remember, these deductions are all based on when you're actually paying the bill or the expense. So if it's in the calendar year for the tax return, that's when you need to be able to benefit from it. So I think it's real important to look at that as well. Another big topic is taxes that you can deduct. The first one that we look at is a pretty basic one. Any property taxes that you're paying on real estate goes on Schedule A as well. So you can deduct that against your taxable income and add on to Schedule A. Sales tax and state income tax, you get to choose the higher of the two. We're based in Washington. State here, we do not have state income tax. There are some individuals that work out of state, and they may be paying income tax, but for most of my clients, we look at the sales tax. This has been a rule that's been extended every few years, so it hasn't been certain every year that we're going to be able to benefit from this deduction. But for 2011 tax returns, you will be able to take the sales tax. Key thing to note about sales tax is the IRS has a table, and you can use the IRS tables or you can keep all your receipts documenting your sales tax. I've had a few clients do the receipts, and it's surprising that a lot of times the IRS tables are very, very close, has been my experience. The good news is, though, with sales tax is if you happen to build a house or do major remodel, home improvements, purchase a boat or an RV or a car, things of that nature, major purchases, you can actually take the IRS table amount and add the major purchases to to your table amount that the IRS gave you. So we've had people that have purchased a vehicle or a large ticket item, and they've been able to add a $4,000 or $5,000 deduction onto the amount of sales tax that the IRS is calculating for them. So that part is really a positive as well. So we want to look for that opportunity when it comes down to looking at sales tax. This is one that I see missed on a lot of people that do their own returns, and so I'm always cognizant to say, hey, make sure you're doing that. A lot of people think, well, that was just a 2 or 3 year law, and they're no longer doing it, but and that's somewhat true because the IRS has been able to say, hey, at the last minute to extend this law. So hopefully one day we'll get it permanent, just like things like mortgage interest and property taxes have been, and we'll be able to go forward from there. So, excuse me. Home mortgage interest. This is a big one. This is what a lot of people purchase a home. They hear, hey, if you purchase a home, you're going to be able to file the long form or Schedule A, as it's more commonly known. And this is all about being able to deduct mortgage interest on your personal residence. And this can be both a first and a second mortgage. And there again, the interest that you pay goes on Schedule A. There's a line item exactly for it. It can be interest paid to a bank or interest paid to an individual. But the key is it's interest paid for your personal residence. Rent is not deductible when it's personal rent, so here's a difference between renting and home ownership. Investment interest. Any interest you're paying based on your investments can be deducted up to the amount of your investment income. So there's a lot of times there'll be investors out there that have some margin interest on their accounts, and they're able to deduct that. There's also the opportunity if you have a second home, and a second home can be a fifth wheel. It can be a boat, as long as you have cooking and sleeping and toilet facilities, and you could actually live on that, you would be able to deduct the interest on a second home. So it doesn't have to be a physical structure as far as that goes. So that's an interest deduction. The other things I always remind people is points that you pay on purchase and refis can be deductible as well. A lot of people will forget they paid points, they refi, or they sell the house. You can write off those points once you refi or sell the house, or over the life of the loan when it's points paid on a refi. When it's points paid on a purchase of a home, you can deduct that fully in the year of purchase. So there again, you purchase a home, you want to obviously start getting track of your interest and that you're paying on a first, second, or just a first. But you also want to look and say, hey, did I pay any loan origination fees or loan discount? And that will help you be able to go forward as far as that goes, along with your points and things of that nature. Another big one that comes up is donations. Donations are deductible, and they can be in the form of cash and non-cash. Cash is very simple. You want to write a check. You want to have some sort of paper trail, but as long as you're giving it to a qualified charity, this can't be to your children or people, I feel bad for them. It needs to be deductible to a IRS qualified charity or 501c3 organization is typically what the terminology that you'll hear out there. You can also do non-cash donations. Here again, you also should have a paper trail, be it a receipt. Take pictures. The higher the non-cash donation, the more you want to talk to your advisor about making sure you've got substantial documentation. Key is here, though, the values of these donations, be it cash or the fair market value of the property, is going to be a deduction that you can take against your income. There again, it'll help lower your taxable income, and there again, you will in turn lower your tax bill at the end of the year. This is always a tricky one. Things like donating cars, artwork, things like that, jewelry. It can be a little dicey, but you can work with your advisor before you do it. The key is just document, document, document. This is an area that the IRS occasionally will look at to make sure that it's all in line. If it's a large amount, you may get a letter, but as long as you've documented it, one of these letter audits, you can certainly say, hey, I paid the money and made the donation. Here's my receipt. Here's my letter, and go forward from there. So I think that's an important thing to look at. Just make sure you're covered as far as that goes. So the next item is kind of a hodgepodge. I call it a miscellaneous deductions. It is at the bottom of your Schedule A, and these things include quite a bit of different things as well. So I'll just run through them real quick. You're looking at employee expenses, union dues, gambling losses, investment expenses, safe deposit box registration, and fees that you pay annually, tax preparation fees. These all go under the miscellaneous item. Another one can be a casualty or theft loss. That's an issue that runs into. There again, that's limited by income as well as most of these miscellaneous deductions. So remember, as we say, it's limited by income. You take your adjusted gross income, which tends to be the bottom number at the front of your 1040 page, and you multiply that by 2%. Earlier I mentioned medical is 7.5% of AGI. This is 2%, so the hurdle's not as hard to get over as far as the numbers concerned. So there again, you want to get as many of these to qualify so you can get this. As I said earlier with medical, some years you may qualify for the deduction and others you don't. But typically the big ones are union dues, the tax prep fees, and if you have any expenses that's directly tied to your work as an employee, you can deduct those expenses that were not reimbursed by your employers. So a common one that I see is as an employee, you drive 20 miles a day for your on behalf of your job. And right now the IRS says, let's say it's 51 cents a mile, but your employer is only giving you 20 cents a mile. Well, you can take the difference. And mileage is one of those things, whether it's personal or as a business deduction, it tends to add up over time. So you're looking there and saying, oh, well, I'm not really driving that much per day or per week. But over a 52-week period, it starts adding up. And there again, some deduction is better than nothing. And if you already can file Schedule A because you've got property taxes, home mortgage, donations, sales tax, we can just add to that. And therefore, the game is, as we've said a few times, lowering your taxable income, therefore lowering the tax. So there again, this is something, if you're not sure, you need to keep track of these expenses. And your advisor, myself, or anyone else will be happy to go through how you need to document these things to make sure you're in compliance if you were ever audited or this ever came up in any kind of question. But the key is to note that if you're an employee and there's some expenses not being reimbursed and you're able to file Schedule A anyway, we have an opportunity. And remember, employee expenses can also include such things as a home office, that you've got expenses for working out of your home that your employer's not paying. And we all can realize for the most part that most employers are doing whatever they can to keep their costs lower. So a lot of things I've seen over the year, employees that used not to have to pay much of anything out of their pocket are now having to pony up and cover certain costs that they didn't have to before. So we do at least have the ability to deduct that, or at least a percentage of that, under the miscellaneous category. Casualty loss and theft loss, these are deductions you can take. So if you have a loss that's not totally covered by insurance or wasn't covered by insurance at all, I always tell people you should have a police report. If it's a theft, you need to be able to document and prove that you had a theft or casualty loss. This, again, has some income limitations, but if you had a major flood or something happened and your insurance didn't cover it, there can be some benefits for deductions as far as that goes. Just to have to, there again, see how the numbers shake out. It's not very often I'm able to take that deduction, but there are usually 2 or 3 people a year that something has happened. The insurance didn't cover it, or they didn't cover very much of it, and then they're sitting there and having to deal with paying this out of their own pocket, and therefore the only benefit maybe they can get through this is being able to take it as a deduction. So that kind of talks about Schedule A. Remember, you get the higher of the standard or the Schedule A/itemized deductions. So we're going to look to make sure we're getting all the deductions that you could take personally. And remember, these deductions have nothing to do with whether you're a business owner, whether you have rental property. Those are completely other sets of deductions and rules, but these are your typical personal deductions that come into play when you hear someone talk about long form or Schedule A or itemized deductions. Now, there's another section, and this section kind of gets overlooked by a lot of people because a lot of people are aware of some of the deductions we've talked about. But on the front of your 1040, the bottom third of the form, you see a section called Adjustments. The first third is your name and all the personal information, Social Security numbers, dependents, things of that nature. Then you have the meat of the 1040, page 1, is income and losses, be it from wages, business, stock activity, investments, all the different types of categories. Then the bottom third or so is the adjustments, which is basically additional deductions. So these things, I will just run down the list real quick to let you know what's available. Some of these things may or may not apply, and then again, some of them are year specific. So, for example, moving expenses. If you move because of a job change, your employer's requiring this, or a job, you're allowed to take moving expenses. There's a separate form that goes with it, but this is an important deduction if there's a move, particularly if your employer, new employer, did not reimburse you for the cost of the moves. So that's something to be aware of. Teachers, there's a special deduction for teachers or educators that you're allowed to take, and that is not limited by income, and so you get a flat amount as an educator fee deduction as long as you paid this amount or more. Health savings accounts, people putting money away in savings account and getting a tax benefit. This is very nice because it does not come under the 7.5% of adjusted gross income that we're talking about earlier. So I find that that's an important thing to be aware of, that if you're funding a health savings account, this is where we're going to get you the benefit of it. IRA or SEP IRA tax deductions. Here again is an area that you get to take your contributions that you put into your IRA. This will comes right off your income. So here again is another line item. Early withdrawal penalties. You cancel out of a CD or a savings account, the bank hits you with an early withdrawal penalty. There's a line item for that deduction. Student loan interest. Those of us out there who have had student loans or are currently paying, there's a line item for being able to deduct that. With a lot of things, these are somewhat income limited, and there is usually a max that you're able to write off. But who cares? If we can deduct $2,000 of the student loan interest, that's $2,000 more off your income that you wouldn't otherwise have. Tuition and fees. There's a deduction on the front of the return. I do caution and say make sure to see if you qualify for the education tax credits. Just a sidebar, remember, tax credits are a dollar tax credit is $1 off your tax. $1 off of a deduction is a percentage off of your tax. So if you have $1 deduction and you're in the 25% bracket, that's 25 cents that's off your tax. Whereas if you have $1 in a tax credit, that's $1 right off your tax bill. So we're always looking for tax credits to take. Unfortunately, there's not as many of those out there as there are deductions. But if you qualify in education, be it for yourself, spouse, and or your dependents, there are some nice education tax credits out there. Some people are not able to qualify for that, and therefore they may get some deduction on the front page of the 1040 as an adjustment for tuition and fees. That's one you definitely want to play with. to see which is the best situation of which you qualify for. So that's the front of the 1040, the adjustments. And then the other one, that this will come up every year, and a lot of people may or may not think of it as a deduction, but it truly is your dependency exemption / deduction. And this is based on the individuals that are listed on your return. If you're just a married couple, you'll have 2 dependents. So you'll have a deduction of $3,700. That's the amount for the dependency deduction this year per person. So in my example with the married couple, that's $7,400 off of your tax return. Now, if you have children, family members, people that are able to be claimed as a dependent, here again you take $3,700 multiplied by that amount of numbers. This is where it gets a little dicey, because who can claim the child or parent or family member as dependent? So we always look at things such as relationship, amount of support. Did you provide over half the support? So there is quite a few tests to make sure you qualify. How much money did the dependent make? What's the age of the dependent? Things of that nature. But you definitely want to jump through those hoops, because there again, $3,700 usually will result in a $700 to maybe $1,200 tax savings on average. So it's good money if you're able to add a dependent to your return. The key is you have to make sure that you qualify, someone else isn't claiming that person, and go forward from there. So that's the dependency exemption. Make sure you qualify if these are your own kids, things like that, and there's not any divorce or separation issues. A lot of times this is a slam dunk. There's also some tax credits if the children are under the age of 17. But there again, when you start looking to see if you can claim your parent or cousin or other people as dependents, that's when you got to make sure that you qualify. But if you do, then you're definitely going to see a benefit on your tax return. So those are the biggest issues that typically come up. I've been going for about a half an hour or so. I'm happy to answer any questions, clarification. Last month we did a webinar based on rental expenses. So you're more than happy if you've got a rental or investment property. I did a webinar, and it's on the website under the recorded or free information, and you can listen to that to talk about different expenses for rental property. I don't believe I've done one for business deductions, but I'd be happy to answer any questions that you have on both personal or business. What I tell people is the IRS rule as far as business deductions is anything that's ordinary and necessary for your business. There were not many law changes really of any consequence from 2010 return to 2011 for business deductions. So unless it's something new, the rules are pretty much going to apply. If you have a similar business, same type of deductions, you should be able to qualify for similar type of deductions. But if there's an individual question out there, I don't know if anyone's sent anything in, Jeff, I'd be happy to answer them.
David, the lines are open, so if you do have a question, you're welcome to go ahead and just speak up. And while we wait and see if anybody on the phones has a question, I'll check the internet for questions.
Can anyone hear me?
Yeah,
I heard something. Go ahead.
Yeah, this is Rocky. At the beginning, you mentioned, at the beginning, you first started talking about tax deductions, and you came up with there's a single deduction and a joint deduction. That joint deduction was $11,600, say, for, I think, 2 people. Am I
right,
correct
married
there?
filing joint. You are correct.
Okay, and then you just finished mentioning the dependents, $3,700 for each dependent.
Yes.
That's separate from that?
That's a great question. That is a totally separate line item on the 1040. So you get the dependency exemption. So if you're a single individual and you have no dependents, you're going to get that $5,800 as a standard deduction, and you'll get $3,700 as a dependency deduction.
Okay.
If you're married, it's $11,600 standard deduction, and $7,400 for 2 dependents, because you can claim you and your spouse.
Right. Thank you.
You're welcome.
And again, the lines are open, so if you do have a question, just go ahead and speak up, and David can answer your question.
David, this is Betty, and I had a question about the dependents deduction.
Okay.
We have a 29-year-old son that was hurt, and he worked a little bit, but then he got unemployment, and then he got L&I, and so how would he, what are the things that would make him qualify for us to claim him, or would we be able to claim him because he's lived with us all year?
Okay, so you definitely, most likely, you provide a roof over his head, and provided for, most likely it sounds like, over half of his support. There is an issue, though, that you said, I believe you said his age is 29?
Correct.
Okay, so, and he did not go to school, I'm assuming he was...
No.
No.
Okay.
And the reason I ask that is if you're up until the age of 24, if you're a half-time, at least a half-time student, you can be claimed on the parent's return regardless of what the income is. But once they get over that age, then what they say is they look at the income. So, for example, if his income's unemployment, then and his income is under, it's a very low number, $3,700, then you can claim them as a dependent. This, unfortunately, hasn't been changed because it's really, I find that, $3,700, which is the exemption amount, is very low, and no one could live off of that that I'm aware of. So that's what you're going to run into. It sounds like to me you definitely qualify for the support and things like that. But if he drew over $3,700 on the unemployment for the year, then it may be problematic whether you could actually take him based on his age.
Okay, now that's unemployment. What about L&I? Because when he was hurt on the job.
Typically L&I and Social Security benefits, they do not count towards the income. But if he worked part of the year before he got hurt, wages, W-2, would be. Now, if he got hurt previously in another year, maybe there are no wages. But Social Security and disability, those are not taxable typically for situations like this. So if he only got a little bit of not Social Security, unemployment, we'd have to look and see. But he very well, maybe he does qualify for this particular year.
Okay, and then like doctor bills, if we claim him, what about all of his doctor bills and expenses and whatnot?
Absolutely, anything not covered. If he's a dependent, for any dependents, then you're able to take the medical expenses for family members that you're claiming, or dependents that you're claiming.
If he paid him, I mean, he borrowed the money from us, but
right.
Would he be better off just doing his own income tax and then filing the schedule?
Well, he might, but it sounds like his income's going to be pretty low. So the first thing you would look at in a situation like that is what is his what is his income? What's the type of income, to see what his tax situation is. It sounds like it's probably not a lot of taxable income for this particular year. So therefore, if you could qualify to take him, then be able to include his medical expenses, then you'd be able to benefit from that. Because like you said, you paid the money to him, loaned it to him, gifted it anyway, and the key is being able to have him as a dependent.
Now, how will that affect him, though?
Well, if he doesn't have to file and his income is very low, it probably will have very little effect on him. Because remember, even if you claim him, he still gets his standard deduction.
Okay.
So that $5,700 for him being single, he's still going to get that write-off. You're just taking the $3,700 dependent deduction.
So I could get all the stuff rather than bring it in and let you guys tell me
Yeah, we could definitely take a look at and see does it qualify, and see what the best situation for you and for him.
Okay. Thank you very much. Thank you.
You're welcome.
David, I think that's it for questions.
Okay.
Did you have any kind of suggestions, whether we're listening live or on the replay, about how soon people can bring in their tax information into the office?
Absolutely. We can start as early. Actually, now the official date that the IRS has given before they'll start accepting returns electronically is the 17th of January. So we're encouraging people to come in sooner than later, because we definitely try to do first come, first serve is kind of our goal. So once you have everything, you'll get a quick turnaround. Remember, we don't charge for electronic filing like some of the big houses, wire houses out there that, nickel and dime people. We will, and that comes with your tax preparation. And if you can have your money direct deposited into your bank account, and that will give you a refund in less than 2 weeks, usually 10 working days, or 10 days, not working days, but 10 days. It's in your bank account, and you're ready to go. So the sooner the better as far as that goes. We're also offering a contest. Most likely it's going to be a nice TV for those that refer clients to us. So both the referrer and the new client will get thrown into a raffle that will raffle off at the end of tax season in the middle of April. So that's an incentive out there to, if you've got a friend that needs help or something, who knows, you can refer us if that's what you'd like, if you're comfortable with that, and get a chance to win a nice prize as a thank you for your support.
Great. It sounds like fun.
It's one of the few times you can turn taxes into fun time.
Good. Well, last call for questions. It looks like everybody has asked theirs, and we didn't have any come through on the internet this time, David, so you did a great job explaining all the different aspects of it. But again, if they're listening on the replay, what's the best way to get a hold of you as we kind of move into tax season, or if they want some more information about how the referral program works?
Absolutely. The phone number for our office is 360-659-8502. You're welcome to email me, David at PettisRumsey, PettisRumsey, so David at PettisRumseyCPA.com. We don't charge for quick questions, so if there's someone out there and saying, hey, I just need to know, can I deduct this before I talk to anybody, or is this true what I'm hearing out on the street? Feel free to send us an email. I'll do my best to get back to you quickly and answer it. You're not going to get a bill or anything like that. We want to develop a relationship, and either calling or emailing will get us going as we start this tax season up.
And David, is it worth mentioning for clients, just so they know where you're located there in Marysville, if they're going to be dropping stuff off?
Sure, it's never a bad idea if you're new to the area. We're off of State Avenue on 76th Street, 4229 76th Street Northeast, Suite 102. We're in a green roofed building. It's a 2-story building called the Jubie Building, Jubie. It's pretty easy to find as you're heading east on 76th Street. We're about 2 blocks off the main thoroughfare in Marysville on your left-hand side, so we're pretty easy to find.
Great. David, thank you so much for all this information. It's been very helpful. And we'll have some more, I guess, email updates about taxes and things like that as we move into tax season to send out to everybody. But until then, we just hope to hear from everybody as they drop off their taxes to you.
Sounds great. Thank you, Jeff, for your help.
Thank you. Bye-bye.
Bye.